Hello everyone, welcome back to my channel. In this video, we're going to be talking about personal income statements, and we're going to be answering what it is, why is it important, and how you can use it for personal financial planning. To start, we need to know what is a personal income statement. A personal income statement shows you your income and expenses over a period of time. It can be monthly or yearly. And for your personal income statements, mostly we are concerned about the cash flow, meaning how much income are you receiving and also how much money you are spending on a monthly or yearly basis. So cash income comes from things like your salaries, any investment dividends, any rental income or interest income. And your cash outflow are things that you spend money on, and it can be broken down into two components: your fixed expenses and your variable expenses. So your fixed expenses are things that cannot be adjusted easily, for example your mortgage or your car loan. And for your variable expenses, these are expenses that you can adjust easily. Things like expenses on your food and also transportations and also the money that you spend on entertainment. So now that we know what is a personal income statement, why is it important? A personal income statement is important because it can help you track your income and expenses and to help you identify where you are spending your money on. So if you're chronically feeling that you don't have much money to spend, I think it would be good for you to come up with your personal income statement and take a look at what you are spending your money on. So now that we know what is a personal income statement, let us take a look at how you can create your own personal income statement and also how can you use it for financial planning. And to help you better understand this, let us use John's personal income statement as an example. This is John's personal income statement at the end of the year. Do know that you can create your own income statement on a monthly or yearly basis. And as we can see, for the whole year, he has received $84,240 in salary and also $2,500 in dividends from his unit trust investment. Do note that there's a gross and a net income. Gross meaning it includes CPF, and net meaning that it is cash only. So the $84,240 that he received for the whole year is inclusive of his employer's CPF contribution. And after we net off all of the CPF contribution, we can see that the net cash income for the year is $60,100. Next, let us look at the expenses. So for John's expenses, we can see that he has a fixed mortgage payment of $27,000 per year, a car loan of $20,000 per year, and also his insurance premium of $4,000 per year, which gives us a total of $51,000 of fixed expenses for that year. His variable expenses includes savings of $5,000, income tax of $2,800, his food expenditure of $12,000, transportation of $7,000, and entertainment fee of $6,000, which gives us a total of $32,800. So if you take his gross income minus away all of the expenses, we can see that there's a positive net cash flow of $2,940, which he can put the money back into his savings account or use it for investments. Next, let's look at the net cash income versus the net cash expenses. As John is using his CPF account to pay for his mortgage, we will not be using this for his net cash expense. So his total fixed cash expense would be $20,000 in car loan and also $4,000 in insurance premium, giving him a total fixed cash expense of $24,000 for the year. Next is the variable expenses, which is all paid by cash, so it's the same as the previous column. And if you take the net cash income and minus away the net cash expenses, you'll find that the net cash flow at the end of the year is $3,300, which you can consider putting back into his savings account or using it to invest. Do note that net cash flow can be negative as well. That will happen if the expense is more than the income. And if the net cash flow is negative, it is very likely that John is either drawing money from his cash reserve to use or he is in debt. So to avoid that, it is very important to set aside a budget and spend within your means. Now that we've looked at John's personal income statement, let us move on to the 4 financial ratios. The first financial ratio is the liquidity ratio, which can be calculated by taking your cash and cash equivalent and dividing it by your monthly expenses. And this ratio shows us that in the event of John losing his job, how many months can his cash last him for? And the recommended amount is to have at least 3 to 6 months of your monthly expenses in cash and cash equivalent. But of course, this is just a guideline, and if you want to be more prudent, you can definitely have more cash in hand. So why is this ratio important? This ratio is important because it helps you to avoid liquidity risk, meaning the lack of cash during an emergency. So having enough cash in hand allows you to tide through some of the tougher periods, and also if you have cash in hand, that will mean that you do not have to sell your investment at a bad time as well. So for John's example, we can see that the liquidity ratio is 2.86. That means if he doesn't have any income, his cash in bank will allow him to survive for slightly less than 3 months. So how he can fix this is to increase his liquidity ratio by saving more money and putting it in his savings account. The next financial ratio is your savings ratio, which can be calculated by taking your total monthly savings and divide it by your total gross income. So this ratio shows you how many percentage of your gross income is being saved, and it is recommended that you save at least 10% of your gross income. But of course, this is just a guideline, because if most of your expenses are fixed expense, like for example, if you have a very high mortgage rate or if you have a lot of dependents, then you might not be able to save so much money. On the contrary, if most of your expenses are discretionary, meaning that most of your expenses are variable, then you can take a look at where you are spending your money at and decide whether or not those are necessary. So you can cut down on them, then you can potentially increase your savings rate. So why is this ratio important? It is important because it shows you how much money you are setting aside to build up your cash reserve or to invest or grow your money. So we can see that for John's example, his savings ratio is 6%, which is not ideal. However, if you include the positive net cash flow for the year, and assuming that he puts the money back into his savings account, then his savings ratio will be closer to 9%. However, it's still not up to the recommended 10%. So how you can fix this is to look at his variable expenses and to decide which of the expenses can be cut down so that he can increase his savings rate. Like for example, he's spending $12,000 a year on food alone, so maybe he can not eat so much Hai Di Lao and eat more Zap Cai Png. The next ratio is the debt servicing ratio, which can be calculated by taking your total debt repayment divided by your total gross income. What this ratio shows you is how much of your income is being used to pay your total debts. And the recommended range is below 35%, meaning that it is recommended that you use less than 35% of your total income to pay off your total debts. And why is this ratio important? This ratio is important because it allows you to see whether or not you are over leveraged. Like for example, if most of your income is being used to pay off debts, then you will have less money to save or less to spend on your variable expenses. So for John's example, we can see that his debt servicing ratio is 54%, which is higher than the recommended amount. So a few ways for him to fix this is firstly to not incur some more debt, and secondly to pay down the current debt, or thirdly for him to increase his income. And the fourth financial ratio is the non-mortgage debt servicing ratio. This can be calculated by taking your non-mortgage debt payment and dividing it by your total gross income. So what this ratio is showing us is how much of your total income is being used to pay for non-mortgage debt, meaning that there are things like your car loan, your credit card debts, or your cash loan from banks. And why is this ratio important? This ratio is important for the same reason as your debt servicing ratio, is to make sure that you're not over leveraged and to ensure that you have enough money for your discretionary expenses. So for John's example, we can see that his non-mortgage debt ratio is about 23%, which is higher than the recommended 15%. So what he can do is the same as before, which is to not incur more debt, slowly pay down his current debt, or to increase his income. So if you notice, the recommended debt servicing ratio is less than 35%, and the recommended non-mortgage debt servicing ratio is less than 15%, which means to say that the rule of thumb is less than 20% for your mortgage payment and less than 15% for your non-mortgage payment. And it's also very important to highlight that the debt servicing ratio and your non-mortgage debt servicing ratio is not the same as your mortgage servicing ratio and your total debt servicing ratio. Your MSR and your TDSR are rules that are imposed by MAS to make sure that the financial institutions don't overlend you your money in relation to your income. Alright, we are almost at the end of the video. Let us just do a quick recap. Firstly, a personal income statement shows you your income and expenses over a period of time. It can be done on a monthly basis or on a yearly basis. And its components are your gross income, which is inclusive of CPF, your net income, which excludes CPF, your fixed expenses, and your variable expenses. And it is important to take a look at your personal income statement because it shows you how much you are making and also how much you are spending. And if you are overspending, how can you cut back on your expenses to make sure that you have enough for your savings and investments. And lastly, the four financial ratios are your liquidity ratios, your savings ratios, your debt servicing ratios, and also your non-mortgage debt servicing ratio. I hope you've learned something from this video. Do give me a thumbs up if you like the video and subscribe if you like the content. And if you have any questions, do leave them in the comment section below. I'll try to answer them. Alright, thank you very much for watching. I'll see you guys in the next video. Bye bye.